Okay, we'd like to call the finance meeting to order, please. Doug, are there any public comments this morning?
We have one public speaker, Murray Bowden.
My name is Murray Bowden. I haven't spoken before this committee before, though I have spoken 3 times already this morning. One of the suggestions that I've been making is that, similar to other organizations in New Jersey, the chairman has made it possible for the public to ask a short question and get a short answer. Now, with the proposed change of going from 11 board meetings to 8, the chairman has said that he would have a session where the public could address questions. Somehow when there's that kind of a session, I'm way down on the list and I never get to say anything. But at these committee meetings, if they could be a little more efficient and less statistics read that are in the book, the chairman, at the chairman's discretion, could make it known that questions could be entertained and answers done quickly. It's New Jersey Transit, Jim Simpson, who used to be on this board, that's where I met him, instituted such a procedure, strictly at the discretion of the chair. And I would like to see that this board, this committee, move in that direction where the chair, at the chair's discretion, could permit very short 10-second questions, not speeches, and maybe a 1 minute. And if the answer requires more, then you say, this is answered, will be answered at another time. Thank you for your time.
Thanks, Mr. Bowden.
Okay, first order of business then is the approval of our minutes of our July 23rd, 2012 Finance Committee meeting. A motion, please. Second, please. All in favor? Any opposed? Minutes are approved. Doug, the committee work plan, please.
Well, there are no official changes to the committee work plan at this point, but the Corporate Governance Committee voted last week to change the structure of selected committees as well as the scheduling of all meetings, and that would begin in 2013, and that would require a full vote by the board this coming Wednesday. So if in fact that happens, what we'll do is we'll alter the scheduled work plan so that it coincides with the new meeting schedule for 2013. Sure. Next is Budget Watch, and this month's Budget Watch is going to focus on preliminary results for August and September, and it'll compare those results against the mid-year forecast that was presented in July. If you recall, the forecast presented that then showed modest improvements over the budget as we had favorable fare box revenue and debt service and some slight reduction in expenses in spite of the fact that we actually increased some maintenance and other programs that would support and benefit the public. So I'm going to go through each area and I'll talk about those individual components. Now, passenger revenues, we had increased $29 million between the budget and the mid-year forecast. From that revised forecast, right now we are better than budget for the month by 8.7, and the year-to-date favorable variance is $13.8 million or 0.4%. Mostly driving that performance is higher subway ridership. In the case of the commuter rails, they're pretty much on target. Long Island is slightly favorable, Metro North slightly unfavorable. With regard to toll revenue, we had taken a slight reduction in the mid-year forecast of $3.5 million, and from that revised forecast, we're approximately on target. With regard to expenses, if you recall, we had reduced our overall expense target for 2012 of about $39 million from budget, as we had some favorable costs for pension, health and welfare, paratransit, energy, and services. And that's in spite of the fact that we had increased our maintenance and other investment efforts by $39 million. We added extra monies for fast track, signal maintenance, elevator and escalator maintenance, and some other maintenance efforts. So from that revised baseline, we think that overall expenses are pretty much on target for the month, although we're showing a favorable for the month and year to date. We're showing a $35 million favorable variance. However, we think a lot of that is timing related, and we think that that will probably even out throughout the course of the year. We think overall we're pretty much on target with that budget, with the mid-year forecast. Debt service, we had reduced in the mid-year forecast, and we're actually, when compared with the mid-year forecast, we're $27 million favorable for the month, $41 million year to date. The vast majority of that is timing, so there's no real story there. Subsidies, when we looked at the mid-year forecast, we pretty much left them flat because we had increases in payroll mobility tax forecasts that were offset by a reduction in some lower real estate taxes that we were seeing then. Compared with that revised forecast, there's a favorable timing variance with MTA aid, but overall net year-to-date subsidies are on target. Real estate revenues are a little favorable, and we've had slight reductions in PMT and PBT collections. To summarize these results, for the month and year-to-date, we're better than forecast. However, a lot of that is timing related, as I mentioned. Real results for the month and year-to-date appear to be tracking very close to the new forecast. Favorable passenger revenue and real estate tax receipts were mostly offset by a reduction for PMT and PBT. Again, pretty much tracking slightly better to the new forecast, but very close. Any questions?
Okay, Pat, Finance Watch?
Thank you. Finance Watch appears on Roman numeral 4-1 of the committee book this morning. In addition, there was a handout that was just put on your chair this morning summarizing the transaction that just priced last week. So it begins with TBTA 2012B, $1.236 billion refunding of outstanding TBTA bonds, and this was on August 3rd, 2012. This issue generated an all-in true interest cost of 2.66% and saved 20% on the refunding itself. Next is Roman numeral 4-2. We have two fuel hedges to report on. The first being on August 6th, we executed a 6.7 million ultra low sulfur diesel fuel hedge for a period of September 2012 out to February of 2014. This was a competitive bid, and in this case, the winning bid was provided by Goldman Sachs, or J. Aaron, at an all-in price of $2.915 per gallon. And then on September 7th, we entered into a similar size ULSD hedge, 7.1 million. Again, the winning bidder here was Goldman Sachs at an all-in price of $3.05 per gallon. We've got a fairly heavy calendar coming in the next couple of months, and you can see here we just kind of list out what is going to be coming down the pike. You'll be getting a lot of emails with remarketing circulars and preliminary official statements and so forth, and you can see the transactions that are coming. There's a fair amount of remarketings. We do have a large DTF refunding scheduled for the middle of October, $953 million. I would just point that out. We do have about $350 million remaining of new money that we're currently estimating sort of the late October, early November time frame for that, and then of course Triborough subordinate refunding. This would be the last of our current candidates that we're going to take out this year, and that's $550 million, again, a November transaction. On September 13th, we executed a termination of outstanding swaps with Citigroup Financial Products, or CFP. These two swaps associated with bonds 2001B and 2001C, and you see $88.5 million and $88.6 million respectively. Those are the notional amounts of the bonds that are outstanding associated with the swaps. What happened here is Citigroup, as the credit support provider for CFP, was downgraded to below BAA1. That caused a trigger event in the legal documents associated with the swaps that allowed TBTA to terminate, and that was done at a discounted value of $19.4 million. That process is provided for in the ISDA documentation of the swaps, and so we had 4 firms participate in that in helping us value that, and that's a market-based termination. And then lastly is the handout that was on your, sorry.
Yeah, Patrick, quick question. I have a hard time understanding these swaps and these terms, the financial terms and whatnot. Can you explain to me with these swaps, like at any point during the course of a year, like say, by the way, if we hadn't had these swaps, the fuel would have cost us X amount of dollars. Can you do a comparison and say, here we saved $100 million or whatever the number is because we did these swaps, or we lost X amount of dollars because we did them wrong?
Okay. On the fuel hedges, I think we're going to have a presentation to talk about the impact of the fuel hedges on the budget, and I think that your question is right on, and Mr. Keller is here going to...
All right. But rather than mix everything together and say we bought these, we sold these, the swaps cost this amount, that amount, how do we fare? The reason that we bought the swaps was to protect ourselves against
Absolutely.
the rising costs.
The fuel hedges are there to really deal with volatility in that particular commodity. That, you know, our fuel budget is about $260 million per year, and it is probably one of the more volatile parts of the budget. As you know, just going to the gas pump, you see the volatility in pricing. The fuel hedges sort of mitigate that volatility for the time period that they're laid on, and we've been thus far doing 18-month fuel hedges that so extend us out.
I understand why you're doing it. You're gambling. You're betting it.
Well, no, I wouldn't say that at all.
Well, if the fuel is X amount of dollars, you're betting it won't go up to this, or you want to lock it in at a certain price.
It's providing budgetary certainty. That's really what it's doing. It's providing budgetary certainty for that part of the fuel that we've locked in. Now, we're not doing the whole fuel budget. We're just doing about 40% roughly.
I understand.
So,
but just I know the fuel goes up and down every day.
Yeah.
But just in the period that you buy these swaps and stuff, if you could just break it down in lay terms for me, like if we hadn't done the swaps,
I think we're going to get into that in a presentation up on the screen here in a minute. So, and then if I could just borrow this for a second. The other transaction to report is the one that we just priced last week. This is the Transportation Revenue 2012F. This was a refunding transaction of outstanding transportation revenue bonds and dedicated tax fund bonds. And as you can see on the second page of your handout, the all-in TIC on this transaction was 3.17%, and the present value savings generated were 17.57% of the refunded bonds. So we had a very strong market last week, and that transaction will close on Friday. So if there's any questions? Thanks.
Anybody have any questions? Okay.
Yeah.
Presentation.
We're going to headquarters, and there are 5 action items.
Sorry.
Yeah, that's okay. But well, what we're going to do in preparation of the first action item to increase the fuel price agreement capacity, David Keller, who's our Senior Deputy Budget Director, is going to give the committee an update on our fuel hedge program, which will lead into the discussion on the approval of the action item.
Good afternoon. You should all have these slides in front of you, but yeah, it is on. Just need to. There we go. Last November, we presented an overview of our fuel hedging activities. We also requested and received approval to expand the terms of our hedge contracts from 12-month duration to durations not exceeding 24 months. Subsequent to that approval, we provided an update in April, and it followed with monthly status tables in your committee reports, in your committee books. This presentation is an update of the April presentation, which is a little bit more extensive than what you see each month in your Finance Committee books. This slide summarizes our hedge activity since March 2011, and this information will be plotted on the next graphs that follow. The first 5 diesel hedges and the 1 natural gas hedge were all entered into prior to your authorization for hedges to extend beyond 12 months. Since that authorization, MTA has entered into 9 additional diesel hedges, including the 2 Pat just mentioned a few minutes ago, each lasting 18 months in duration. Prices on this table and on all subsequent tables and graphs represent only the commodity prices. It excludes contractual markups for delivery, profit margin, etc. that the MTA pays along with the commodity price to our vendors. The 14 diesel hedges that are plotted here, and I'll do the first 5 first. This is actually the actual commodity price according to CME Group. It's where we get our actual data from in terms of prices. This is Gulf Coast ultra-low sulfur diesel, which is what our hedges are based upon. As you can see, there's been a lot of price volatility since January of 2011. Our first 5 hedges, which were all entered into prior to extending the duration beyond 12 months, were $3.16, $3.12, $3.05, $2.98, and $2.85. They all gradually went down. Subsequent to extending our authorization to 24 months, even though we only did it to 18 months, the prices were $2.89, $3.12, and $3.21, and then followed by that high number, it started going down to $3.16, $3, $2.77, and $2.70. The last 2 that Pat just talked about, which are not factored into our costs yet, are the $3.92 and the $2.92 and the $3.06. As you can see, as prices fell during 2011, the lock-in price for the hedges also declined. In 2012, the commodity price on the open market was $3.18 a gallon, while our average hedge price, which are these, was only $2.96. The below-market average hedge price, however, does not include the impacts of these 2 most recent hedges, which began in September and will begin in October. With those two trades factored in, our average hedge price is in line with the August market rate. The August market price, excuse me. Again, these are the actuals from January 2011 through August of 2012, where August hit $3.18. The dashed line represents the average hedge price. That's the weighted average of all our hedges. And the bars represent what percentage of our fuel, this is ULSD only, was hedged in each month. For 2012, the adopted budget assumed $2.99, which is the red bar, and the commodity price is $3.18, but our hedges softened some of the differential, and our blended price, which is this, the blend is the weighted average of both our hedged and unhedged amounts, was $3.09 a gallon. So hedging actually reduced the impact of the higher prices that we would have had to pay. Although it is higher than our budgeted number, it's still lower than the actuals. Natural gas, we've only done 1 hedge, which was at $4.24. It expired in March of 2012. So the average hedge price and the hedge price for that 1 hedge are the same. As you can see, actual natural gas prices, again, this is just the commodity. This is the Henry Hub commodity price, have declined steadily. It hit $2.17 in March 2012 when our hedge expired. Starting in the middle of 2011, the price of natural gas steadily declined, falling over $2.50 from June 2011 through April 2012. Since April, the price has crept upwards, yet MTA has not executed new natural gas hedges. Future prices, which hedge prices are based on, have regularly hovered in the neighborhood of the price forecast in our financial plan. In February, we expected natural gas to be $4.17, growing to $4.70 in 2013 and $5.05 in 2014. If we executed hedges at this time, we would be locking in the higher prices because we'd be locking in what the future prices are. So if the actual prices do not end up going as high as these current future prices are, we would be not able to lock in any of the favorable variance that prices would occur. As you asked a few minutes ago, these are the actual impacts on the financial plan of our hedging. For 2012 through September 19th, the higher price for diesel is currently projected to unfavorably affect our financial plan by just over $7 million. But the hedges that we've executed are expected to buffet that impact by almost $3 million for a net unfavorable of $4.1 million, as opposed to, had we not hedged at all, having an adverse impact of $7 million. For natural gas, prices are much lower than the assumption in the adopted budget, and we currently project savings in 2012 of about $32 million. The one natural gas hedge we executed is estimated to have cost us just over $1 million, so the net impact is a favorable $31.3 million for natural gas. And at the bottom you see the summary of a net impact of $27.2 million in 2012 for the natural gas and ultra-low sulfur combined. Until recently, natural gas prices have not been volatile. In fact, they steadily declined. Ultra-low sulfur diesel, on the other hand, has been very volatile. In 2011, there was an 86-cent differential between the high price and the low price per year, which would equate to about a $64 million impact on the MTA's annual ultra-low sulfur diesel budget. To date, in 2012, there's been a 73-cent differential between the high and the low for the year, which would equate to a $54 million budget swing. Because we have limited resources available for hedging, our hedging activity has targeted ULSD, which is currently the more volatile of our fuel forecasts. When the current hedge program was authorized at the end of 2010 with $100 million and approval to hedge over a 12-month period, we were able to cover about 38% of our fuel costs with the hedges. At the end of 2011, further authorization allowed us to extend those hedges to between 18 and 24 months. Enabling us to have a full calendar year hedged at any one time. We have entered into 18-month hedges, however, rather than the fully authorized 24 months, because the extended term lengths, without an increase in permitted capacity, actually reduce the percentage of our fuel budget covered by hedges down to 26%. If our terms were for the full 24 months that we're authorized for, that 26% would reduce even further to covering only 18% of our fuel budget. Today we'll be asking to increase our hedging capacity by $100 million to a total of $200 million. With 24-month term hedges, we will again be allowed to cover about 38% of our annual budget with hedges and over a 2-year period. Okay. Are there any questions?
Mr. Chairman, can I ask? So,
Mitch, go ahead.
if I'm looking at the last chart,
Yes.
and if I understand the last chart, we've saved in calendar year 2012 up through September 19th, because of the hedges, $1.947 million.
That's correct.
So I'm reading that correctly?
That's exactly right.
Does that 1.947 include the cost of the transactions?
I believe the cost of transactions is built into the dollar.
That's in there.
It's
Yes.
built into the price.
So it's a net number,
Yes.
not a gross number for which you have to add the administrative costs of incurring the hedges.
No, it's all in.
It's all in there.
Okay, so basically, we've saved $1.9 million this year. Part of that is because the amount we have hedged for a variety of factors has gone down, based upon your presentation, and now the goal is to raise that number back up to a higher amount percentage of our costs of the hedges.
That's correct.
Okay, good. I'm glad I understood that. Thank you very much. That's what okay.
Do we have, is there a variable time that we can hedge? Do you have to do a whole year? Can it be 6 months? Is there flexibility in those?
There is. The market would allow for periods, as you described, 1 month, 3 months, 6 months, so forth. It is. Yeah.
And Pat, talk about how the hedges are laid out. When you do a 12-month or 18 or 24, that it's a sequence of hedges. You're doing it month by month.
Right. So we'll lock in that price, $2.92 for example on this last one, and that's the price per gallon for the 18-month period beginning with the next month. The hedge settles on a monthly basis, so at each month we look at how the actual price of the commodity has changed over the month, and we compare that to our lock-in price, and we either make a payment to the counterparty or we receive a payment from the counterparty depending on that relationship.
What period have we been using? Have we been locking in a year or 6 months or 18 months or what?
As David noted, when we first began the program, we started with a 12-month duration. And then when we sought the formal authority this year, we began an 18-month hedging. Now the board has authorized us to go out to 24 months, but at this point we've been doing 18 months. Now we'd like to go out for that additional 6-month period to lock in the full 24-month window. And again, that's why we want to. You'll see a staff summary too.
But isn't there's a pro and a con to locking in 24 months? Obviously, I mean that's a lot can happen in that time, and we could be, you know,
right. Well, the one thing that we know is
the
we're a constant consumer of the commodity. We know we're going to need that fuel this month and 24 months and so forth. So. Again, because of the way the financial plan is built, going multiple years out, we're only covering a part of the financial plan.
And are you still aiming for approximately 40% of the fuel supply to be hedged?
That's
Yes.
correct.
And another reason for the 24-month, we're talking about biennial fare and toll increases. So we don't want to get caught halfway between a fare and toll increase and suddenly have the market have a complete disruption. And as you could see from the graph that David had up there, again, we're not trying to lock in a specific number, but what we're trying to do is we're trying to reduce the volatility of our operating expense by that. And so we'll never be perfect. There's going to be times when the hedge we locked in will be higher than the market price, and there will be times clearly when it'll be lower. But again, instead of having the big swings, we're trying to have smaller swings in a level that we think we can absorb. So for instance, right now at about 40%, we think if the market should fall out of bed and prices on the rest of the 60% would go up, between our general reserve or our ability to just belt tighten, we ought to be able to manage through that period. But again, having certainty for 24 months helps us a lot when we're doing biennial fare and toll increases. So that's part of the thought that goes into it as well.
I assume that you are laddering these hedges. Is that correct?
That's correct.
My question to you is as follows. Since fuel or energy hedges are among the most volatile in the commodities market, and bearing in mind the lesson of J.P. Morgan, are we really safe in going out as long as you are, or propose to be?
Well, we do have stringent credit standards for the entities that that bid on the hedges, and again, we competitively bid these with entities that have been approved by the MTA in line with the board-approved swap guidelines. So, to answer your question, we believe we're dealing with strong entities that can that will be in business through the duration of the hedge. So at this point, we are only dealing with two entities, Goldman Sachs and Deutsche Bank. The third entity that we have dealt with in the past and is approved is Bank of America Merrill Lynch. But Bank of America suffered a downgrade, and that their rating is below our standard, so we don't allow them to participate. We're actually working to get one or two more entities into the pool to bid on the hedges that meet the credit requirements that we demand.
Put aside the entities, because members of my firm, but not I, act for some of those entities from time to time. My concern is in a particularly volatile period that we have now, are we taking an extraordinary risk in going out long? That's my concern. Because the time is volatile, it'll get more volatile next year.
Yeah, actually, 24 months is not that long of a period, and in times of extreme volatility, I would be more comfortable knowing that 40% of my fuel cost has a certain price. So I think the greater the volatility is, the more I'm committed to this plan. If we had, as you saw with the natural gas, there is very little volatility that we were seeing, and it was a downward trend, so we were not speculating, but we made the decision I'd rather put the resources toward where the volatility is, because again, Chuck, as you say, volatility is risk, and the greater the volatility, the more I'm convinced that the hedging program, the way we do it on a month-by-month basis, so we're never just rolling the dice and locking in a hedge at the beginning of the year. Every month, the amount of collateral effectively that frees up gives us the ability to make another hedge for that period of time. So I'm comfortable.
Doug, you want to, do we need a motion here now?
Yes.
Okay, would you please make it?
Can we have a motion on that action item?
This is on 5-1 of the book.
Right.
All in favor? Any opposed? So passed. Doug, go ahead.
Sure, we have two other action items. Pat, do you want to take us through the board approval of the remarketing agent?
Okay, this is on Roman numeral 5-3. This is to seek approval of PNC Capital Markets, LLC, as remarketing agent. And this is on, as I went through the list of transactions that we're going to be working on over the coming months, one of them involves a credit substitution of a bank that's exiting a series of variable rate bonds. That's BNP Paribas. It's exiting, and we solicited and got proposals from banks to step into their shoes and provide letters of credit, and PNC was one of the banks that did do that. We've analyzed their remarketing capabilities and believe that they would be a suitable remarketing agent, and we're seeking board authority to add them as an approved agent.
I recuse myself from this vote and discussion.
Okay.
Okay, so we have a motion, please? A second, please? All in favor? Any opposed? So moved. Doug, go ahead.
The next one, we require board authorization to purchase MTA, TBTA, DTF bonds, and 2 Broadway cops on the open market. Pat,
Okay.
did you need to add anything?
Sure. Roman numeral 5-4. This, I think, provides for up to $25 million to allow us to purchase bonds from investors that want to sell those bonds at par or less. And here we're thinking that this is not intended to be a major change on the operating budget. It's just allowing us to be opportunistic and purchase bonds that are outstanding in the market where there is no liquidity for those bonds.
I just have a question. Without this resolution that we're about to vote on, you don't have the authority, just through your normal investment powers, to invest in securities of this rating and grade?
No, I think we do have the authority. One of the things we wanted to do is we wanted to set some parameters around it and talk to the board about it, and here the parameters, the $25 million.
I'm supportive of that. Maybe we should even broaden it so that you don't have to come back to us every time you want to invest, a few $1 million in ourselves.
That's right.
But this, food for thought, perhaps.
Okay.
It becomes, we've retired it. Excuse me, we've retired it.
It's gone.
Right.
Right.
What we've looked at is we do have cash, not a lot, as you understand how tight our operating cash is, but we're receiving very little on it. And if we do have a chance to buy a bond at a significant discount because of some individual's, personal need, we'd like to do it. We have the ability to do that underneath our existing documents, as Pat said. We're just trying to put some parameters around it so that you have comfort and confidence that we're not going to do something that would have a disruptive effect on our operating budget, but we're just asking for a $25 million. That may take us several years to hit. It could, if it was the right opportunity, happen earlier, but we would not exceed that without coming back to you and seeking additional authorization.
Okay, may we have a motion, please? Second, please. All in favor? Any opposed? So moved.
Next, we are seeking MTA Board approval to file for and accept federal grants for federal fiscal year 2012 and 2013.
Second, please. All in favor? Any opposed? So moved.
The last one, we're seeking to obtain board approval on items necessary to final the procurement of an owner-controlled insurance program and OSIP for projects within the 2010 through 24 capital program covering New York City Transit, Long Island Railroad, Metro-North, and the Small Business Mentor Program.
Motion, please. All in favor? Any opposed? So moved.
Next, we're moved to headquarter procurements. We have 5 procurements for headquarters, 4 competitive and 1 ratification of a contract for headquarters for a grand total of $6,487,368.
It was competitive, too. Next. Okay, a motion, please. Second, please. All in favor? Any opposed? So moved.
Next, we're moving to the commuter rail agenda. There's 1 agency action item for MTA Capital Construction with Long Island Railroad requesting board approval to add a project entitled the Biltmore Room Connection to MTA Capital Program's interagency program at an estimated cost of $15.5 million. Funding is available with the current 2010 to 2014 program.
Motion, please. Second, please. All in favor? Any opposed? So moved.
There are 6 procurements from that committee for a grand total of $17,194,469. For Metro North, there are 3 competitive, 2 for RFPs for a total of $2,111,719. For the Long Island Railroad, there are 2 competitive procurements, 1 multi-agency with Metro North and B&T, 1 jointly with Metro North, and 1 competitive procurement for a grand total of $15,082,750.
Motion, please. Second. All in favor? Okay. Any opposed? Opposition? So moved. Jim, you wanted to say something?
If you wouldn't mind going back to that interagency pot, could you just mention how large that is in the bill warrant?
That was $15.5 million.
How big is the pot that's coming out of?
Can I read here?
That would be someone from Capital Construction, Capital CPM here.
I thought that was coming out of the Metro North Capital Construction, not out of ESA.
All right, well, we'll get, the easiest thing is, Bob, why don't you get, do we have an answer?
Money's coming out of the rail planning, coming out of the interagency rail planning bucket. I don't know the specific project, but I can get back to you on that.
Okay, we'll get back to you on that. We'll get the information for you. Let them get they'll get it. Okay, Doug, on MTA bus operations?
Sure. We have 1 competitive procurement requesting approval to use the RFP process for the purchase of up to 285 over-the-road diesel express buses with an option to purchase up to 15 additional buses.
Motion, please. Second. All in favor? Any opposition? So moved.
Next is bridges and tunnels. We have 2 contract modifications, one of which is in a multi-agency contract with Metro North and New York City Transit for a grand total of $906,097.
Motion, please. Second. All in favor? Any opposition? So moved.
Next, New York City Transit. There are 2 action items. The first one, to obtain MTA Board approval to add a new structural repair project to the capital program. The scope of the project includes structural work along the Broadway 7th Avenue line in Upper Manhattan. The project has completed design, and the estimated cost of the work is $15.2 million, including design, third-party construction, and all required support. Award of construction work is forecasted for March 2013. This may be accelerated into the 4th quarter of 2012, necessitating this action. Funds are available in the 2010 through 2014 capital program. This is a result of good bids on recently awarded work. That would be 1.
Second, please. All in favor? Any opposed? So moved.
1 other action item, to add 2 new projects to the 2010 to 2014 capital program, to install help points, highly visible intercom devices allowing customers to speak directly to New York City Transit employees for travel info and emergency assistance in selected subway stations, and to install passenger station local area networks in selected subway stations, which will support the rollout of help points and the new fare payment system.
Motion, please. Second, please. All in favor? Any opposed? So moved.
Okay, there are no items for FIMTAC, and then included within the book are consolidated statements for both June and July, since we hadn't had a meeting since July. It also includes the calendarization of the consolidated mid-year forecast, which are the results that we're publishing financials on a monthly basis and Budget Watch. That's for your information. Next would be
Okay.
real estate.
Real estate, David.
Good afternoon. Jeff is ill and could not be here, so I'm standing in for him. First, I should say that Jeff will be back in October to give a full report on the MTA right-sizing initiative, including the planned disposition of the Madison Avenue buildings and the moves of the various occupants from these buildings. We have 4 real estate action items. They're explained in detail in the staff summaries. I'm happy to take any questions on them. Otherwise, I would ask for their approval.
Second, please. All in favor? Any opposed? So moved. Tell Jeff we hope he feels better. And now we need a motion, please, to adjourn our Finance Committee meeting. Second, please. All in favor? Thank you very much.